Hi everyone, it's Jabba in the video, and today I'm going to be talking about Rowe Price, a dividend aristocrat that's really not that far off its 52-week lows. It's an investment management company relatively well known. It's had 36 years of consecutive dividend growth. It's been an excellent stock to hold over the long term. Over the last couple of years, value really peaked in November 2021 as the market peaked, and this is going to be a theme throughout this video. This is kind of a cyclical play in the sense that when the stock market is doing really well, this business is doing really well. When it isn't, this business isn't. That's just something you have to rationalise with that. However, right now it is paying a 5% dividend yield, well covered with a payout ratio of 63%, which is not perfect, but free cash flow is relatively depressed right now. And I think this is perhaps a reasonable time to buy. I'm going to put that across in this video, what I think of it, go through its most recent results and its valuation versus its historical valuations. I think the cyclicality can be quite easily visualised by looking at a graph of the assets under management of the last 15 years or so. You can see, 2018 was a down year where they lost the majority of the money just from market change rather than a loss of net flows into the business. In 2022, there was $61 billion, or nearly $62 billion of net flows out of the business. However, the massive majority was just market change, $351 million. As with any investment management company, assets under management is the name of the game. Higher assets under management means higher revenue. Effectively means more clients, or at least more client money and more revenue. So that is the name of the game for this business. And over the long term, they have increased assets under management at a decent rate, often better than the market. However, when they're in recessionary times, they can't really be expecting a significant amount. You can see in 2023, even though they have had $125 billion of market change growth of their assets under management, they've still lost $53.5 billion of net flows out of the business. And that's mainly because of sentiment in the stock market right now. You can see they've saw periods of massive growth in assets under management over the last few years, but right now sentiment is kind of against stock market investing when you can just get better returns for most people investing in treasuries or something, or at least safe returns. So here's some net revenues for this business, and the reason they're so tethered to assets under management is because 90% of this business's net revenue in this period at least is investment advisory fees, which is such a large percentage that it's almost the only thing that's worth talking about. From Q3 2023, investment advisory revenue was $1.463 billion out of a total revenue of $1.67 billion. That's compared with the previous year of $1.588 billion. That's about a 5% increase, which is relatively impressive and kind of what you expect considering the market's got a bit better with some outflows but not ridiculous outflows. And compared to the previous quarter, they're also doing a little bit better with an increase in CAPI and a little increase in management fees. But overall, this business is performing exactly how we expect a business like this to perform, single-digit growth year over year. And after a relatively tough time in the previous year, they're definitely improving as the market improves. Here's a graph of assets under management, more importantly of net flows, and that's what I'm most interested in here, is that middle chart on the bottom row, is the net flows for institutional and retail investors. You can see, even though the assets under management is slightly over 50-50, but in general there's slightly more institutional money rather than retail money, so pension funds, etc. You can see retail investors are actually leaving, or net outflow from retail investment dollars is far higher than the investment retail, more than double in some cases. This is reasonably expected. Institutions often have a longer term outlook, particularly pension funds and things like that. But this is a worrying trend if it continues, because it's pretty much continued steady net outflows throughout the years. Not really been any period of massive decline. Institutional investment has kind of gone down for only $4 billion of outflows, but retail investors, significant outflows all year long. Now looking at operating and net income, which is probably for actual investors and for its share price matters a lot more. You can see operating income up only around 1%, not particularly impressive year over year. Had a really bad Q4 2022 when the market was down, where their operating margin effectively halved. Now, this can happen from time to time, one-off expenses, etc. But their operating margin generally is in that 35% range, sometimes a bit lower, sometimes a bit higher, but it can generally be pretty consistent in that 32 to 35% range, which I'm quite happy with. And on a net income basis, they had significantly improved net income versus the previous year, but it was down quarter over quarter from Q2 2023. The adjusted earnings per share has gone in the right direction over time, but that is with adjustments. So the net income has increased quarter over quarter and year over year, but it's not particularly impressive because that is with adjustments. So I don't put too much stock in that. but overall, trending in the right direction. It's always going to be a tough market for this business, and when the market is like this business very rarely does outstanding. However, it generally does better than you would expect. The reason most people are interested in this business is because it's a dividend aristocrat and it consistently returns capital to shareholders, and that is no exception. In the current quarter, they've returned around $386 million, most of that through the dividend. They occasionally do special dividends. They did one in the last 3 years. In the last 12 months, they returned just shy of $1.4 billion to shareholders. In the last 3 years, it's around $6 billion. That is an enormous amount for a business of this market cap. Currently has cash or cash equivalent around $2.5 billion. That's up massively from where it was last year. In Q4 2022, it was only $1.8 billion. Exactly last year, it's 2.36. It's not a massive increase by any means, but it's going in the right direction for sure. And this will probably be distributed at the current share price to buying back shares, and then when the market's stronger, they kind of slow the share buybacks down normally and just buy back shares more conservatively. And when the market's low, they do it a bit more aggressively, and I'm expecting that going forward. Obviously, this is a decent business. The reason why it came to my attention is because it's so depressed year to date. It's right near its 52-week lows. It's massively reduced from its highs. And logic dictates you would think that the valuation is really low. Right now, that isn't really the case. It's kind of just in line with its 5-year averages. Now, those averages weren't really dramatically affected by 2020, and you can see the price to earnings on a trailing basis just generally pretty steady in that 12 to 17 range, currently sitting 14.13. The 5-year average is 14.5. Now, that is a significant discount to the S&P 500 right now, but I don't see any real reason why this business, any catalyst for it just suddenly getting a much larger multiple. Price to cash flow is actually higher than its 5-year averages, currently trading at around 18 times, 5-year average around 15 times. This is massively skewed by the 2022 and 2017 numbers. 17, 18 is probably pretty much in line with where it normally is, so nothing particularly expensive here. Price to book is a little bit below its 5-year averages, but not anything to really scream about. It's tough to really value this business on a price to book value, in my opinion. Price forward earnings around 16, so its earnings are predicted to decline. PEG ratio has gone through the roof because analysts are not expecting a particularly strong year for the stock market next year. Recession's baked in perhaps. So an earnings yield of 7% is decent, but free cash flow yield is much worse. I'm not thinking this is an absolutely staggeringly cheap company by any means, even at 52-week lows, because its earnings roughly track with how the market is doing. The market is doing poorly. Its earnings are doing reasonably poorly. Its price comes down, and its multiple source stays the same. Could this be a cheap business from this point onwards in 3 years? Yeah, possibly this could be a really good price if the market continues to rise, but this could be dead money for a year, and that's my concern here. Obviously, with the recent inflation numbers, a dividend yield of 5% will be beating inflation, so that is not necessarily completely dead money. 64% payout ratio is okay, and a really strong growth rate. So over the long term, this is probably going to be a fantastic company for home. But its recent bounce, it's slightly away from its 52-week lows to around $100 now. Still cheap versus 52-week highs, but I just don't think this is a staggeringly cheap business. I think its valuation is not particularly enticing me. I think there's better options around. In the dividend aristocrat space, maybe there isn't better options for a 5% yielder with a decent payout ratio. However, for me, there's just better place for my money at the minute. So I'm going to keep this one as I'll wait and see what happens. If for some reason it plummets to below $80, I'll be really, really interested. But with the recession coming up, I can really see that happening, and then I'd perhaps be more interested. That being said, none of this is direct financial advice. None of it's personalised. You shouldn't take it as such. Let me know what you think in the comments down below. I'm of course not a financial advisor, so you should do your own research and due diligence, and remember your capital is always at risk. Like and subscribe and share the video. I'll see you again next time.